All right, so in chapter 3, we are going to be dealing with the income statement, and we're also going to be talking about the different types of transactions, that are going to be affecting the income statement, whether it's going to be revenues or expenses, and we'll also explore some of the different account titles on the income statement. So the first thing is looking at these things called operating activities, which, operating activities include things like buying goods and services from suppliers, paying your employees and so forth. So we'll be looking at, collecting cash, again, selling goods, buying goods and services, as well as paying cash to not only your suppliers, but also, to your employees. So you can check out this basic income statement. You'll notice, again, here's our title. We always have a time period, like for the month ended, and then we're going to have different headings, like we have a revenue heading. In this case, they had 2 revenue items. Then you're going to have an expense heading, where they're going to list all their individual expenses. And of course, we know the income statement summarizes your revenues and expenses. Now remember, in GAAP, when you're following GAAP, we're always looking at these time period assumptions. And of course, and we'll get into the revenue recognition principle coming up, but typically time periods is that typically you look at a company in terms of months and quarters and years, and you can break these up. So in this case, they looked at the company in terms of months. So we have this time period issue, and eventually we'll get into the concept of the accrual accounting and the revenue and the matching principle with expenses. All right. We also have what's called cash basis accounting. Of course, this is non-GAAP, but if you're under a cash basis of accounting, you only record revenues and expenses when cash is either received or when it's paid. So it's not really a good method for the timing in terms of reasonableness, in terms of what's happening in a certain time period. So typically what we've got in financial accounting is, again, when we follow the GAAP, we explain, and what they do, they apply the revenue and expense recognition principles. And so, of course, GAAP, IFRS, we have what they call as the accrued basis of accounting, which we record revenues when they are earned, and expenses basically in the same period as to the revenues in which they relate. So you try to match these up, because the expenses help to generate the revenue. And so it doesn't depend on cash. So you could earn something in one period and get the cash in another period. And so hence, there's always going to be some timing issues when you're following the generally accepted accounting principles of accrual accounting. Now, regarding revenue, we have a 5-step model for revenue reporting. And of course, it's the timing of it. And of course, this is not cash revenue. It's going to be essentially this 5-step model. They've helped us identify it on the next slide. It's a little bit bigger, but you typically have to identify some sort of contract. And then you're going to identify that there's some sort of performance that you have to do. Again, from the seller's perspective, there should be a price determined. And then at some point in time, you have to allocate that transaction price to the performance. And then finally, you recognize it when that performance obligation is satisfied. And again, on the next slide, it's basically saying the same thing, but it's a little bit easier to see. But again, identify the contract, identify your performance obligation, meaning you have to either sell something or provide a service. There should be some sort of price determined. Then you have to allocate that price to that obligation, link them together. And then at some point in time, the performance obligation has to be satisfied. So they've determined this. It's a legal way to say this is the official way of when revenue should be recognized. And then eventually I'll get to the slide, we'll talk about the expenses would then be matched up against that revenue. Okay, but again, when they're talking about the cash receipts, again, cash receipts is non-GAAP. That only occurs when cash is either coming in. Revenue is only recognized when cash is coming in, and expenses are only recognized when cash is going out. There's no timing. So when we get to this expense recognition, which they do call the matching principle, the idea here is you record the expenses in the same period that as the revenues with which they can be reasonably associated. So you're trying to say, okay, once the rule is you recognize the revenue. Once you follow that 5-step process, then you go and gather or try to determine all of your expenses that help to generate that revenue and match those up in the same time period. And that's why they call it the matching principle. Okay, so next up, we'll take a look at some transactions. Again, we'll go back and again, follow the accounting equation. We'll look at T accounts and journal entries, just like we did in chapter 2. So again, here's our expanded equation. Notice your assets, liabilities, equity. And again, notice that we've got under equity, you've got one part, which is your investments. And then we've got retained earnings, which of course, revenues and expenses are going to be affecting retained earnings. So those revenues will be increasing retained earnings and expenses would be decreasing it along with dividends. But of course, generally, your revenues and expenses would usually be summarized in net income. And then that will, of course, then be transferred to retained earnings. But again, retained earnings is going to be that part of the balance sheet that where all your revenues and expenses are going to be transferred eventually. Okay. All right. So looking at some transactions. So in this one, we've got where they sold, Noodle Cake sold $3,000 of games at its online store. So that's going to be a sell. And so notice this is going to be cash. They don't tell you account, just assume cash. So increase cash, and then you're going to be increasing revenue. And the journal entry would be to debit cash, credit revenue. You're increasing both. And then of course your ledger would then summarize that posting of cash as a debit and the posting of revenue as a credit. All right, and then on the next one, we've got, again, in this case, they issued 3 $100 gift cards at the beginning. So again, this is going to be a deferral because usually gift card, you have an obligation, you haven't actually performed the service yet, so there's no revenue. So it's like being paid in advance. So you got the cash and you're going to increase your liability. It's like an unearned revenue, unearned deferred revenue. That's a liability. So you debit the cash, you credit that revenue account, which is a liability. And then of course, here, that would be your postings to your ledger. So you analyze it, you can record it as the appropriate debit and credit journal entry, and then you'd summarize it again in your ledger. All right, so they sold $9,000 of apps in the App Store and Google Play. So in this case, they've actually earned the revenue. They've actually sold it. But in this case, they're putting this into its on credit. So it's going to go into accounts receivable. You debit 9,000, or I'm sorry, the debit will be down here, but you increase it for 9,000, you will be debiting it in your journal, and you're going to be crediting your revenue. So here's your journal entry, and then of course you would post it to your ledger. Okay, next up it says we received payment on account. So you're just receiving your cash from your accounts receivable. So you're going to say increase cash, decrease accounts receivable, which is debit cash, credit accounts receivable. And of course, here's your ledger. There's your posting to summarize your journal. Next one, you are paying cash to your employees. So again, notice cash will be decreasing on your assets. And then also that's an expense that's going to be reducing equity. Debit wages expense because you're increasing expenses, credit cash because you're reducing cash. And then of course you can see the posting into your ledger. All right, next one, you paid cash in advance. So this is going to be a prepayment. So again, 2 assets, you're going to reduce cash and increase that prepaid. Again, notice only assets are affected. You'll debit one asset and credit the other and then post them to your ledger. Okay, next one says incurred in cost to be paid later. So this is going to be an accrual where you've got an expense, you just haven't paid it yet. So again, this is your accrual accounting. This is your matching. You've got to record. And again, let me get the my right arrow on. It's easier to show you. So you increase the expense, so this reduces equity, and you also increase your liability. So debit your expense, credit accounts payable, and then of course you're going to post it to the appropriate ledger account. All right, next one. Now you've got some cash expenses. So that one you're just going to be reducing cash and increasing your expenses, which again is reducing equity. So debit your expense, credit your cash, and then you would post it to your ledger. And then of course this would be your ledger summary, just like before. Again, notice you've got your debit and credit side, cash, of course debit balance, accounts receivable, debit. All these balances are on the appropriate increase side, whether it's your assets. You got your liabilities, which are all on the credit side. And of course, here's your stock, which is credit side. Expenses are the weird one because they have a debit balance, but the reason is the way the debit and credit rules work is that your expenses kind of act like the assets in terms of the balance. But think of it as like, even though it's a debit balance, you're actually increasing the negative part of equity. So these are still reducing equity. Okay, so now at this point, you could then, of course, make sure your debits equal your credits. And of course, you could do a trial balance, just list the accounts. These are all from your ledger. And of course, you can see that your debits do equal your credits at 53,000. Okay. So again, there's just a little bit of review. Anytime that you receive revenue, you receive cash before you've actually earned the revenue, this is called a deferral. So you'd increase cash and this deferred revenue would become a liability account. And then once you've earned it, you would decrease the liability and then increase revenue. Sometimes you have cash and revenue at the same time, cash transactions. And then sometimes you might have revenue that's earned before the cash is received. In that case, it will go into accounts receivable. And then later on, you would go ahead and then collect that cash once they pay you. So those are the different items that could be affecting your revenue account that goes on the income statement. Same thing with the review of your expenses. You could pay the expense before you've incurred it. That's called a prepaid expense. So that's actually an asset. And then later on, you'd have to do an adjusting entry to convert that prepaid into an expense. That's what they're showing you right here, debiting an expense and crediting a prepaid. Again, we'll do that in chapter 4. Sometimes you could have cash and expenses that occurred at the same time. And then other times you could incur an expense and pay it later. In that case, you would have the expense debited right now, credit accounts payable, and then later on, you'd pay the money. So hopefully you're seeing that depending on when that expense gets reported on the income statement, lots of times there's going to be a timing difference between when that cash flow is also reported. Okay, looking at what's also called the net profit margin. So notice we can check this out on this one. So notice your net profit margin is simply your net income divided by your total revenues. And in this case, it looks like they took 3,100 and divided by 12,000. So they're basically keeping 25 cents on the dollar, 25.8%. And then of course, they looked at net income. Your bottom line net income was 3,100. So this is just telling you that essentially, if you keep 3,100 out of total revenues of 12, this is basically what your return is, or they call it as your net profit margin. Okay, and they're just talking about some of these limitations. Is just remember, if you go back, that a lot of these items on here that we're dealing with net income, revenues, and expenses, you could have non-cash items included in those. So just because you have net income of 3,100 doesn't mean that you have $3,100 in cash that you have right now. That could be completely different than your cash flow. So lots of times it can be a little misleading if you don't understand the concept of accrual accounting and these GAAP income statements. All right, so next up is we're just going to look at some of these solved exercises in chapter 3. I'll walk you through a few of them. And again, we'll go through some of these transactions where we have the accrual basis idea of revenues, which basically say, you recognize revenues when you've earned them, and expenses, you recognize those when you have incurred them, which typically you incur them as you generate your revenue. So on some of these transactions, you can see, and it's kind of going back, you can look at these activities. Let me get my arrow on. So notice we've got, they collected money from customers for services related to games played in July, 12,000 bucks, and they billed them. So each of these have individual transactions. And so then we'll kind of go through the explanation and then figure out exactly how we're booking the actual journal entry. And we'll get to that in a minute. And here's 3 more transactions regarding when an expense might be recognized or when you've incurred it. So for example, they paid $1,500 to plumbers for repairing a broken pipe in the restrooms. That, of course, will be an expense. They paid $2,000 for the June electricity bill and received the July bill for $2,500, which will be paid in August. So, of course, the $2,500 is an expense in July. The $2,000 was, that was an expense in June and is not an expense in July. So there can always be timing differences when you pay something when something is billed. If you paid weekly wages, of course, that's going to be an easy one. That's going to be your expense. So this kind of shows you in terms of journal entries how you would report these. So notice here was just cash revenue, where you're debiting cash, crediting revenue. This was just your billing your client, so you got your AR and your service revenue. This was where essentially you were paid cash in advance, so you increase cash, increase deferred revenue, and then letter D is just a collection from that accounts receivable. And then, of course, on your expenses, you can see here is just a cash expense. Here is just paying your liability. Here was a utility bill where, of course, you've been billed, but you haven't paid it yet. So debit expense, credit accounts payable. And then on your salaries and wages, that's just kind of like your weekly payment. That would just be a cash expense. Okay, so just looking at some more transactions. So look at the first couple. So again, some of these are from the last chapter too. So issuing cash for stock, you debit cash, credit stock. Part B, incurred utility costs, and we'll pay them next month. Well, the fact that you've incurred them, you have to record an expense, and then the offset will be to an accounts payable. So you debit utilities expense, and then you credit accounts payable. All right, next one, looks like you got paid wages for the current month. That's just going to be a wages expense and debit and then credit cash. Next one said you perform cleaning services on account. That's going to be an accounts receivable. So debit AR, credit your revenue. Notice you've earned it. Letter E says you have some equipment that was repaired at a total cost of $150. The company paid the full amount at the time, so that's just a cash payment. So on that one, you're just going to debit an expense account and then credit cash. All right, let's keep going on these. So we got some more of these to look at. So again, we've got some online services that you provided. Again, it's on account, and you've seen these a lot. So you'll be debiting accounts receivable, crediting a service revenue. Then it says on the last day of the month, a junk trader paid $50 cash to run an ad promoting the company services. Well, that's just going to be a cash payment that incurred in that month. So that would just be debiting expense and then crediting cash. All right, next one, you've got received cash and membership fees for the month from new members. So you'd be debiting cash, crediting your service revenue. Letter D, received the electric bill. The bill will be paid next month. So that's going to be an accounts payable item because you haven't paid it yet, but you still have incurred it. So you have to debit that utilities expense, credit accounts payable. Last one, where you billed somebody. Anytime you billed them, but you haven't collected, meaning you've earned the revenue. So that's all going to go into accounts receivable, and you credit that service revenue. All right, and then the rest of these, this is just, again, your principal, your recognition principle and revenue. I've already I mentioned this earlier, but it's the same 5-step model where you have to identify some sort of contract. It could be verbal, written, or even implied. There should be some sort of promise, some sort of obligation that you're going to perform. The price has to be determined at some point in time. That price needs to be tied into the obligation, and then at some point in time, you have to actually perform the service at what point in time. Once you follow these steps, then that's how you follow it. That's when you determine if you can recognize revenue. And this says, basically, that's your same 5-step model. All right, so there'll be some more slides I'll illustrate on, but this is just your basic stuff we'll be doing in chapter 3. And then we'll show you some more textbook problems. And then I also have another homework illustration to walk you through how to work some of the problems.